Hi, welcome back. Today we're going to look at the 4 questions. These are the questions that you need to ask yourself when you're looking at a transaction. Last video we talked about debits and credits. We knew that there were 5 different types of accounts: our assets, our liabilities, our owner's equity, our revenue, and our expenses. We know the definition for each of these. Assets are things that we own. Liabilities are things that we owe. Owner's equity is our capital plus our profit less our drawings. Revenue are things that we have earned, and our expenses are our costs of doing business. Last video we also worked out that when we're increasing an asset or an expense which are debit accounts, we debit those. And the liabilities, owner's equity, and revenue accounts are credit accounts, and we increase those with a credit. So now that we have this information, we need to learn how to use it. And we're going to do that via the 4 questions. These are the questions we ask ourselves whenever we look at a transaction, so we know what we're doing. So the first question we ask ourselves is, what accounts? There always has to be at least 2, because we're going to have our debit and our credit, or our yin and our yang. What type of accounts are these? Are they an asset? Are they a liability? Are they expenses? That's why it's so important that we know the definition of all of our 5 different types of accounts, so that we can do this second step. Are we increasing or decreasing the account? Do we have more because of this, or do we have less? And then based on that, knowing what type of account it is and whether we're increasing or decreasing, we can then work out which one is the debit and which one is the credit. Let's put this into an example. So our business goes out and buys a forklift, which we pay cash for. So let's go through our 4 questions. What accounts? Well, here, obviously, one is going to be forklift, the other one is going to be cash. What type of account are these accounts? Well, our forklift is an asset. Our cash is also an asset. Our third question, are we increasing or decreasing the account? With a forklift, we're going to have more forklifts now, so we're going to increase that account. With cash, we're spending our money, so therefore we have less, so we're decreasing. We can now apply our debit and credit rules. An asset which we're increasing is a debit. An asset which we're decreasing is a credit. So you can see how the 4 questions work hand in hand with that knowledge that we built last video. Let's have a look at another example. Here we're going to buy some machinery which we're going to pay for via taking out a loan. So our first question, what accounts are being affected here? Obviously, one is going to be machinery, the other one is going to be loan. What type of accounts are these? Our machinery is an asset, our loan is a liability. Our third question, have we got more or less? Now, we now have more machinery because we've bought machinery, so we're increasing that account. Our liability, because of this transaction, we now owe more money, so we're increasing our liability. Now we can apply our debit and credit rules that we have learnt. So an asset which we're increasing is a debit. A liability which we are increasing is a credit. So you can see how that information is so important now. That when we look at a transaction, we can ask ourselves the 4 questions. We know our 5 types of accounts. We know our definition. We know our debit and credit rules now. So therefore we can work out what's going to be the debit and what's going to be the credit. Join me in the next video when we start working out what do we actually do with this knowledge. Now that we know what's the debit and credit, how do we write that into a journal, and how do we then post that into our general ledger? And what is a general journal and what is a general ledger? Hope to see you then. Thanks.